Warren Buffett, an investment legend. Warren Buffett is a name known by almost everyone in the financial world. Often called the godfather of modern-day investing, his reputation is built on decades of success. Who is Warren Buffett? For nearly 50 years, Warren Buffett has been leading Berkshire Hathaway, a company that serves as a holding firm for numerous other businesses. Under his leadership, Berkshire Hathaway has acquired over 60 companies, including major names like Geico, insurance giant, Dairy Queen, fast food and ice cream chain. Beyond owning entire companies, Berkshire Hathaway also holds minority stakes in some of the largest global corporations, such as Apple, Coca-Cola, Bank of America Corp., Mitsui & Co., Mitsubishi Corp., Occidental Petroleum Corporation, Kraft Heinz Co., Chevron Corp., American Express Co., Moodys Corporation. Buffett's wealth. Through smart investments, Buffett has built an extraordinary $82.5 billion fortune, making him the third richest person in the world. What sets Buffett apart even more is his philanthropic mission. He has committed to giving away nearly all of his fortune to charity. The Oracle of Omaha. Buffett is famously known as the Oracle of Omaha because of his remarkable ability to forecast market trends and make successful investments. His investment philosophy, developed over decades, is admired and studied by many aspiring investors. In this discussion, Buffett offers his thoughts on what influenced his investment strategy, the principles and experiences that shaped his approach to investing, how to succeed in today's market, advice on how to master the modern investment landscape. Warren Buffett, often regarded as one of the greatest investors of all time, has built his fortune through a disciplined and thoughtful approach to investing. His strategy is grounded in principles that emphasize patience, deep understanding of businesses, and long-term value creation. Unlike short-term speculators, Buffett focuses on buying high-quality companies at reasonable prices and holding them for years, if not decades. The following key points outline Buffett's core investment philosophy, which has guided his success and serves as a timeless model for investors seeking sustainable, long-term growth. Here are key points of Warren Buffett's investment strategy. 1. Value investing. Focus on buying undervalued stocks with strong fundamentals. 2. Long-term perspective. Invest in companies with sustainable competitive advantages and hold for the long term. 3. Quality businesses. Invest in companies with a strong brand, consistent earnings, and good management. 4. Economic moat. Look for companies with a durable competitive advantage that protects them from competitors. 5. Patience and discipline. Avoid market noise and wait for the right opportunity. 6. Focus on cash flow. Prioritize companies with strong and consistent cash flow generation. 7. Avoid speculation. Do not engage in short-term speculation or timing the market. 8. Diversification. Maintain a concentrated portfolio of high-conviction investments. 9. Reinvest profits. Reinvest dividends and earnings to compound returns. 10. Focus on business, not market movements. Make decisions based on the company's intrinsic value, not market fluctuations. Understanding Value Investing, a teaching guide. Introduction to Value Investing. Value investing is a straightforward strategy where the goal is to purchase investments like stocks, bonds, or real estate at a price lower than what they are worth, essentially buying assets on sale. This involves identifying an asset's intrinsic value and waiting patiently until the asset can be acquired at a price below that value. In this lesson, we will explore 1. The history of value investing. 2. How to calculate intrinsic value. 3. Alternatives to value investing. What is value investing? At its core, value investing means purchasing investments at a price that is lower than their actual worth. The concept emerged in the 1920s with the research of Benjamin Graham and David Dodd at Columbia Business School. Their ideas were laid out in influential books like Security Analysis and The Intelligent Investor, both of which became foundations of the value investing philosophy. One of Graham's most famous students, Warren Buffett, has become a renowned advocate of this strategy, proving its long-term success. Key principle: owning a piece of the business. When you invest in a company, you are not just buying a stock, you are buying a piece of the business. Therefore, it's important to evaluate the company's fundamentals, which are its financial health, profits, assets, and liabilities. This is where fundamental analysis comes in. It helps you estimate the intrinsic value of the company. How to calculate intrinsic value. Intrinsic value refers to what an asset is truly worth based on its potential to generate cash in the future. Warren Buffett describes intrinsic value as the discounted value of the cash that can be taken out of a business during its remaining life. This means we look at the company's future profits, then use a discount rate, usually an interest rate, to figure out what those future profits are worth in today's terms. Because this process involves many assumptions, the intrinsic value is typically a range, not a single number. Tools for estimating intrinsic value. 1. Price to book, PB ratio. The PB ratio compares a company's stock price to its book value, net worth divided by the number of shares. A PB ratio below 1.0 suggests that the stock is priced below the company's actual net worth. 2. Price to earnings, PE ratio. The PE ratio compares a company's stock price to its earnings. A lower PE ratio generally indicates that a stock is potentially undervalued, but it's just a starting point for further analysis. Alternatives to value investing. 1. Growth investing. Growth investors focus on companies that are expanding faster than others, often reflected in high PE and PB ratios. While value investing seeks bargains, growth investors prioritize companies with rapidly increasing profits and revenues, even if the stock price is already high. 2. Technical analysis and day trading. Unlike value or growth investing, technical analysis uses past market data to predict future price movements. Day traders focus on short-term price fluctuations rather than the intrinsic value of a company. Value investing through mutual funds. Investors can access value investing by investing in mutual funds that focus on value stocks. These funds, such as the Vanguard Value Index Fund, include stocks that are deemed to be undervalued based on financial metrics like PE and PB ratios. For example, Vanguard Value Index Fund, a value-focused fund, PE ratio equals 18.1, PB ratio equals 2.1. Vanguard Growth Index Fund, a growth-focused fund, PE ratio 38.8, PB ratio equals 8.2. Growth funds may have higher returns in some periods, but both approaches can be successful over the long term. Final thoughts. Value investing is a proven strategy for building long-term wealth. By focusing on the fundamentals of a company and determining its intrinsic value, investors aim to buy solid companies at discounted prices. However, it's not the only path to successful investing, as growth investing and other strategies can also deliver strong returns under different market conditions. Both strategies have their strengths, and the key to success is choosing an approach that aligns with your financial goals and risk tolerance. Warren Buffett often emphasizes the importance of taking a long-term perspective when investing. He advises that you should seek out companies that possess what he calls a moat, a sustainable competitive advantage that protects them from competitors and ensures they can maintain profitability over time. When you find such a company, your goal is not to buy its stock with the intent to trade it frequently, but rather to hold it for the long haul. Think of yourself as part owner of the business and ask yourself if it has the qualities to thrive for many years, even decades. A company with a durable competitive advantage, whether through brand strength, cost efficiency, unique products, or industry leadership, will continue to generate value regardless of market fluctuations. Buffett believes that the stock market is not a place for quick riches. Instead, it rewards patience and discipline. If you've done your homework and bought into a company with strong fundamentals, you can let compounding work its magic over time. As he famously said, "Our favorite holding period is forever." Investing in the right companies and holding them allows you to benefit from their growth, innovation, and consistent earnings over many years. Certainly. Here's how Warren Buffett might explain the concept of investing in quality businesses, using his classic, straightforward style. When you're looking to invest, always focus on companies with what I like to call economic castles. These are businesses that have built a strong brand, something people trust and come back to time and time again. Think of Coca-Cola, for example. People don't just drink Coke because it's a beverage. They drink it because it's Coca-Cola. Next, you want to look at consistency. Can this company earn money in good times and bad? A business that shows steady, reliable earnings over the years is one you can count on, even when the market gets rough. And finally, the people running the show matter a lot. You need management that not only understands the business, but has integrity and the drive to make smart decisions with your capital. Good management knows how to reinvest profits, control costs, and grow the business without taking unnecessary risks. When you find a company that hits all three, strong brand, consistent earnings, and good management, you've found a business that's worth holding on to for the long run. This blends Buffett's focus on simplicity, his belief in the long-term value of good businesses, and his emphasis on management integrity. Warren Buffett often talks about the concept of an economic moat, which is essentially a company's ability to maintain its competitive advantage over a long period. This advantage is what keeps competitors at bay and allows a company to remain profitable. Here's how Warren Buffett might explain it in his straightforward, folksy manner. Imagine a business as a castle. Now, if you own that castle, you'd want to protect it from invaders, those invaders being your competitors. To keep them out, you'd need a moat around the castle. The wider and deeper the moat, the safer the castle. In the business world, that moat is a company's durable competitive advantage. Some companies have a shallow moat. They might be profitable for a while, but without any real edge, competitors will find a way in, copy their products, or undercut their prices. On the other hand, companies with wide moats, think of Coca-Cola for instance, have built a brand, a network, or a product that is very hard to replicate or replace. That moat allows them to keep competitors from encroaching on their market and keeps their profits intact for decades. When you're investing, you want to find businesses with strong, lasting moats, businesses that can withstand the test of time and fend off competition. These are the ones that will protect your investment and allow it to grow. In Buffett's teachings, the focus is always on finding businesses that aren't just successful today, but have the characteristics to remain successful for many years. That's the essence of a wide economic moat. Patience and discipline, avoiding market noise, and seizing the right opportunity. One of the key traits in successful investing is learning to do nothing when there's nothing worth doing. The market is full of noise, daily price movements, headlines, and endless predictions from so-called experts. Most of it is irrelevant. If you allow yourself to be swayed by every piece of news, you'll end up making emotional decisions that lead to poor results. The truth is, you don't have to act all the time. In fact, the best investors often sit on their hands, waiting for the right opportunity. You need patience. Remember, you're not buying stocks, you're buying businesses. A great business at the right price doesn't come around every day, but when it does, you need the discipline to act. It's like waiting for the perfect pitch in baseball. You don't swing at everything. You wait until you see something that's square in your strike zone. When you find that, you swing, and you swing big. The key is that you're prepared. You've done your homework, you've blocked out the noise, and you're ready when the time is right. So stay disciplined, be patient, and when the right opportunity presents itself, take action with confidence. The principle of focusing on cash flow might be communicated like this. When evaluating a business, one of the key things I look for is strong, consistent cash flow. You see, profits on paper can be deceiving. Companies can show great earnings but still run into trouble if they aren't generating enough cash. Cash flow is the lifeblood of a business. It shows how much actual money is flowing into the business and is available for reinvestment, paying down debt, or returning to shareholders. Companies that can consistently generate positive cash flow, even in tough times, are the ones you want to own. They're able to weather economic storms, invest in growth, and provide long-term value to shareholders. So always prioritize businesses that generate reliable, strong cash flow. It's a true sign of a well-run company. This approach ties back to Buffett's preference for solid, enduring companies that manage their finances well. The lesson on avoiding speculation would sound something like this. One of the biggest mistakes an investor can make is trying to predict short-term movements in the market. This is pure speculation, not investing. The stock market is unpredictable in the short run, and anyone who thinks they can time it consistently is likely fooling themselves. Instead of focusing on short-term gains, look for businesses with strong fundamentals that you believe in for the long haul. Buy them at a fair price and let time work for you. Remember, the stock market is a device for transferring money from the impatient to the patient. This reflects his emphasis on patience, value investing, and staying grounded in long-term fundamentals rather than chasing short-term profits. Here's how Warren Buffett might explain the concept of diversification with an emphasis on maintaining a concentrated portfolio of high-conviction investments. Diversification is a protection against ignorance. If you know what you're doing, why spread your money thin? A lot of people believe in spreading their investments across many different assets, thinking it will reduce risk. And while diversification has its place, it can also dilute your returns. If you've truly done your homework and have strong conviction about a few great businesses, why scatter your capital into your 10th or 15th best idea? At Berkshire, we believe in placing significant bets on high-quality companies that we deeply understand. Concentration is not about taking unnecessary risks. It's about reducing risk by investing heavily in what you know best. The key is to focus on businesses with durable competitive advantages, strong management, and long-term growth potential. When you find those rare opportunities, it's far better to invest significantly rather than spreading yourself too thin across numerous investments you're less confident about. Remember, the goal isn't to own a little piece of everything. It's to own large pieces of a few things you truly believe in for the long run. Buffett's approach often revolves around making big bets on a few great companies that he understands well, rather than diversifying too widely, which can lead to mediocre results. The principle of reinvesting profits. One of the smartest moves you can make as an investor is to reinvest your profits. When you receive dividends or earnings from your investments, don't spend them right away. Instead, put them back into the business or investment that generated them. This allows your money to work for you in a compounding fashion. Over time, reinvesting your profits helps to create a snowball effect. Small gains start to grow larger, and before you know it, you're earning returns not just on your original investment, but on all the profits that came after. It's not about how much you make today. It's about how much your money grows tomorrow. The more disciplined you are in reinvesting, the more your wealth will compound over time. Patience and reinvestment are the real keys to building long-term value. This reflects Buffett's emphasis on the power of compounding and the discipline of reinvesting for future growth. Don't let the ups and downs of the stock market distract you. The real key to investing is focusing on the business itself, not the market's mood swings. When you own a piece of a great company with strong fundamentals, its long-term value will prevail, regardless of what the market is doing today or tomorrow. Always look at the intrinsic value of a business, how well it earns, manages, and grows its assets. If the business is sound, the stock price will reflect that over time. So, ignore the noise, focus on the business, and let the market come around. Buffett often emphasizes the importance of understanding and valuing the business rather than reacting to market volatility. Investing in Warren Buffett's favorite stocks can be a great way to follow a proven strategy, but it's essential to understand the process step by step and tailor it to your own financial needs. Let's break down the key steps to successfully invest in Warren Buffett's stocks while understanding his strategy. Step 1. Do your own research. Warren Buffett is known for selecting stocks that he believes have long-term value, but just because a stock is in his portfolio doesn't mean it's right for you. You need to research the stock. Look at the company's fundamentals, such as its financial health, business model, and growth potential. Assess the fit. Consider whether the stock aligns with your own investment goals and risk tolerance. For example, if you are nearing retirement, you may want more stability, whereas younger investors may be able to take on more risk. Remember, everyone's financial needs and goals differ, so what works for Buffett may not necessarily work for you. Step 2. Open and fund a brokerage account. Once you've identified which Warren Buffett stocks you'd like to invest in, open a brokerage account. This is the platform where you'll buy and sell stocks. Many online brokerages today offer commission-free trading and easy-to-use interfaces. Fund your account. Transfer money from your bank account into your brokerage account. Place a buy order. Once your account is funded, you can place an order to buy the stocks you've researched. The transaction will typically be processed instantly. Step 3. Adopt Warren Buffett's long-term strategy. Warren Buffett's investing style is built on long-term thinking. Here's how you can incorporate his principles. Focus on businesses, not just stock prices. Buffett looks for companies with strong fundamentals that he believes will grow over time, rather than trying to buy or sell based on market trends. Be patient. Buffett believes in holding stocks for the long term, sometimes for decades. This allows you to ride out short-term market volatility and benefit from the company's growth over time. Ignore the hype. Don't be swayed by the latest hot stock. Stick to companies that have real, sustainable value. Why Warren Buffett's stocks appeal to investors. Buffett's approach to investing is based on simple but profound principles. Patience and discipline. Buffett has been investing since he was 11 years old, and his approach centers around patience and avoiding impulsive decisions. Diversification. As the CEO of Berkshire Hathaway, Buffett oversees a portfolio that includes stakes in a wide range of industries, from insurance and railroads to technology and financials. Consistency in returns. Berkshire Hathaway's stock has outperformed the market over the long term, offering strong returns to its shareholders, proving the value of a well-managed, diversified portfolio. Step 4. Understand Berkshire Hathaway's portfolio. Warren Buffett's company, Berkshire Hathaway, holds a vast and diverse portfolio. Some of the companies Berkshire Hathaway owns or holds major stakes in include Geico, insurance; Duracell, batteries; Dairy Queen, fast food; Apple, technology; American Express, financial services. Berkshire Hathaway also invests in dozens of other businesses, both public and private. How does Buffett choose stocks? Buffett is known as a value investor, which means he looks for stocks that are trading for less than their intrinsic value. This approach is based on intrinsic value, the actual worth of a company based on its fundamentals rather than the current market price. Buffett uses methods like the discounted cash flow (DCF) model to estimate a company's future cash flow and determine whether it is undervalued. Long-term holding. Once he buys a stock, Buffett often holds onto it through market ups and downs, focusing on long-term growth. Step 5. Consider consulting a financial advisor. If you're uncertain about which Warren Buffett stocks or any other investments are the right fit for your portfolio, it may be a good idea to consult a financial advisor. They can help you assess your risk tolerance and financial goals. Build a diversified portfolio that aligns with your objectives. By following these steps, you can invest wisely in Warren Buffett's stocks while making sure the investment aligns with your own financial strategy and needs. Warren Buffett is often regarded as one of the most successful investors in history. He's earned the nickname the Oracle of Omaha because of his ability to consistently choose investments that perform well over time. His investment company, Berkshire Hathaway, has a strong track record of owning stocks that grow in value. This success has led many investors to follow Buffett's strategies closely, sometimes even mirroring the stocks he chooses for Berkshire Hathaway's portfolio. Now, let's explore the top 10 stocks in Berkshire Hathaway's portfolio, ranked by how much of the total portfolio they represent. These rankings are based on the latest 13F filing with the U.S. Securities and Exchange Commission, SEC, along with additional research from reliable financial media sources. By paying attention to these stocks, you can gain insights into Buffett's investment philosophy and perhaps use it as a guide in your own investing journey. Apple is the world's most valuable public company, and it holds a special place in Warren Buffett's portfolio as his largest stock investment. Since Tim Cook became the CEO of Apple, the company has consistently delivered strong returns to its long-term shareholders, continuing to grow its value over time. Berkshire Hathaway, Buffett's investment company, started investing in Apple in 2016. Over the years, that investment has grown tremendously. Today, Apple, AAPL, makes up more than 41% of Berkshire Hathaway's total equity portfolio, meaning it is by far the company's biggest holding. This reflects Buffett's belief in Apple's long-term potential and highlights how important this stock is to his overall investment strategy. For anyone studying successful investing, Apple's role in Buffett's portfolio is a key example of how a well-chosen stock can become a major asset. Coca-Cola is one of the largest consumer staples companies in the U.S., known for offering a wide range of products, including its famous Coca-Cola soda, along with snacks and sports drinks. Despite being in fiercely competitive markets, Coca-Cola has consistently delivered solid returns and reliable dividends for decades, making it a favorite among long-term investors. For Warren Buffett, Coca-Cola holds a special place in his investment portfolio. It's actually the oldest stock position in Berkshire Hathaway's portfolio. Buffett started buying Coca-Cola shares back in 1988. He has publicly stated that he will never sell his shares in the company, a testament to his confidence in Coca-Cola's long-term value. Today, Coca-Cola represents about 7% of Berkshire Hathaway's total equity portfolio. This demonstrates Buffett's investment philosophy of buying and holding high-quality companies, especially those with strong brands and consistent performance for the long haul. For students of investing, Coca-Cola is a classic example of how steady, long-term growth can be achieved by owning companies that provide everyday products. Bank of America is one of the top financial institutions in the U.S. It provides a wide range of services, from checking and savings accounts to credit cards and mortgages, making it a key player in consumer banking. The company also serves business customers around the world with various financial products and services, helping to strengthen its global reach. Warren Buffett first invested in Bank of America, BAC, in 2011 during a time of uncertainty when the Eurozone debt crisis posed challenges for the bank. Buffett saw potential in the company despite the difficulties it faced, and his investment has since paid off. Today, Bank of America makes up more than 10% of Berkshire Hathaway's equity portfolio, reflecting Buffett's confidence in the company's long-term success. This investment highlights one of Buffett's core principles: seeing value in strong companies, even in times of crisis, and holding on to them for future growth. For anyone studying investing, Bank of America is a great example of how taking calculated risks during challenging times can lead to major rewards. Mitsui is a massive global corporation with over 5,000 employees and offices in 63 different countries. Despite its worldwide presence, the company is headquartered in Tokyo. Mitsui operates across various industries, including mineral and metal resources, energy, infrastructure, nutrition, and agriculture, making it a highly diversified company. In June 2023, Warren Buffett expanded his investments into Japanese companies, including Mitsui. Like the others in Buffett's Japanese portfolio, Mitsui trades on the Tokyo Stock Exchange. However, American investors can still invest in Mitsui through American Depository Receipts, ADRs, in the over-the-counter OTC market. ADRs allow U.S. investors to buy shares of foreign companies without directly trading on foreign exchanges. While many ADRs and OTC stocks may have issues with liquidity, which means it can be harder to buy or sell shares quickly, that's unlikely to be a problem with a company as large as Mitsui. For students of global investing, Mitsui shows how large multinational companies can offer diverse opportunities and how investors can access foreign markets through tools like ADRs. In June, Berkshire Hathaway increased its investment in 5 major Japanese companies, a move that shifted a couple of American companies out of Berkshire's top 10 holdings. Warren Buffett has stated that he plans to hold these Japanese stocks for the long term, showing his confidence in their future growth. Among these investments, the largest stake Berkshire currently holds is in Mitsubishi Corp. Mitsubishi Corporation has a long and storied history. It was founded in 1870 by Yataro Iwasaki as a small shipping firm with just 3 steamships. Since then, it has grown into one of the largest publicly traded companies in Japan. After Japan's post-war restructuring, Mitsubishi was reincorporated in 1954, bringing together several companies that had split apart but reclaimed the Mitsubishi name. For those studying investing, Mitsubishi shows how a company with humble beginnings can evolve into a major global player. Buffett's decision to invest in such a historic and successful firm highlights his strategy of looking for companies with solid foundations and long-term potential. Let's take a closer look at Occidental Petroleum, commonly referred to as OXY, and understand its position in the U.S. energy sector, as well as Warren Buffett's involvement with the company. What is Occidental Petroleum? Occidental Petroleum is a U.S.-based energy company that focuses on 2 key areas: exploration and production of crude oil and natural gas. This means that the company finds oil and natural gas deposits, extracts them from the ground, and sells them as energy resources. Now, when we compare Occidental to other major energy companies like Chevron, one major difference stands out. Occidental is primarily focused on the U.S. market. In fact, in 2022, about 80% of its production was expected to come from the United States. Chevron, on the other hand, has a more global presence, working in many regions around the world. This domestic focus means that OXY is heavily tied to the U.S. economy and energy demands. Warren Buffett's involvement with Occidental Petroleum. Now, let's shift gears and talk about Warren Buffett's role in Occidental's recent history. Back in 2019, Occidental needed extra financing to complete its purchase of Anadarko Petroleum, another energy company. This is where Warren Buffett's company, Berkshire Hathaway, stepped in. Buffett initially bought preferred stock in OXY, which is a type of stock that gives investors certain advantages, like higher dividend payments. Since then, Berkshire Hathaway has continued to build a large stake in Occidental Petroleum. Some analysts believe that Buffett might even have plans to acquire the entire company in the future. As of now, Occidental makes up nearly 4% of Berkshire Hathaway's total holdings. That's a significant portion, showing Buffett's strong interest and confidence in the company. Key takeaways. 1. Occidental Petroleum is a U.S. energy company that focuses on domestic oil and gas production. 2. In 2019, Warren Buffett began investing in the company through Berkshire Hathaway, first by purchasing preferred stock. 3. Berkshire Hathaway has since grown its stake, with some speculating that Buffett may be interested in buying the entire company. Today, Occidental represents nearly 4% of Berkshire Hathaway's portfolio, showing its importance within Buffett's investment strategy. This helps us see how Occidental Petroleum plays a major role in the U.S. energy market and how Warren Buffett has strategically positioned himself as a key investor in the company. Let's explore Kraft Heinz Company, KHC, and Warren Buffett's involvement with this major food and beverage brand. What is Kraft Heinz? Kraft Heinz is a giant in the food and beverage industry, and it was formed in 2015 when 2 well-known companies, Kraft and Heinz, merged. The company is co-headquartered in Chicago and Pittsburgh, meaning it operates from both cities. Kraft Heinz is famous for making a wide variety of products. You've probably seen some of their iconic items on grocery store shelves, such as Heinz ketchup, Kraft cheese products. But their reach goes beyond just these well-known brands. Kraft Heinz produces everything from snacks and drinks to processed foods, making it a major player in the food sector. Warren Buffett's investment in Kraft Heinz. Now let's talk about Warren Buffett's role in Kraft Heinz's history. Buffett's company, Berkshire Hathaway, first invested in H.J. Heinz Co. back in 2013. At that time, Buffett teamed up with 3G Capital, a Brazilian investment firm, to help them acquire Heinz. In 2015, Buffett was also involved in the merger of Heinz and Kraft, which created the Kraft Heinz company we know today. However, Buffett has openly acknowledged that this hasn't been one of his best investment decisions. Although Kraft Heinz remains a strong brand, the company has faced challenges in recent years, leading Buffett to admit that his expectations for this investment haven't been fully met. Current status of Kraft Heinz in Berkshire Hathaway's portfolio. Even though Buffett admits that Kraft Heinz hasn't been his finest investment, it still represents a significant portion of his portfolio. As of today, KHC makes up around 3.8% of Berkshire Hathaway's holdings. That's quite substantial, showing that despite some difficulties, Buffett continues to hold a meaningful stake in the company. Key takeaways. 1. Kraft Heinz Company, KHC, was created through the 2015 merger of Kraft and Heinz and is headquartered in both Chicago and Pittsburgh. 2. Warren Buffett's Berkshire Hathaway first invested in H.J. Heinz in 2013, and Buffett helped facilitate the 2015 merger with Kraft. 3. Buffett has admitted that this investment hasn't been one of his most successful choices, but KHC still makes up 3.8% of Berkshire Hathaway's portfolio. This shows us how even seasoned investors like Warren Buffett can have mixed results with certain investments, yet still remain involved in major companies like Kraft Heinz. Let's dive into Chevron CVX and its significance both in the global energy industry and as part of Warren Buffett's investment portfolio. What is Chevron? Chevron is one of the largest and most diversified energy companies in the world. It operates across multiple stages of the energy production process, which means it's involved in exploring for oil and gas, extracting these resources from the ground, refining them into usable fuels, retailing petroleum products to consumers, like gas stations. In terms of size, Chevron is the second largest energy company in the U.S. market, just behind ExxonMobil, XOM. Its operations span across the globe, making it a key player in the energy sector. Warren Buffett's investment in Chevron. Now, let's talk about Berkshire Hathaway's involvement with Chevron. Unlike some of Warren Buffett's longer-term investments, Chevron is a relatively new addition to Berkshire's portfolio. Buffett first purchased shares of Chevron in late 2020, during a period when energy companies were dealing with uncertainties caused by the global pandemic. This move showed Buffett's belief in the long-term strength of the energy sector. Chevron's position in Berkshire Hathaway's portfolio. Since Buffett's initial purchase, Chevron has become a major part of Berkshire Hathaway's holdings. Chevron now represents about 8.3% of Berkshire's portfolio, making it one of the company's top investments. This large stake signals Buffett's confidence in Chevron's continued growth and stability, despite the challenges that can arise in the energy industry. Key takeaways. 1. Chevron CVX is one of the world's largest and most diversified energy companies, involved in everything from producing oil to selling petroleum products. 2. Chevron is the second largest U.S. energy company, right behind ExxonMobil. 3. Berkshire Hathaway first purchased shares of Chevron in late 2020, making it a relatively new holding in Buffett's portfolio. 4. Chevron now makes up around 8.3% of Berkshire Hathaway's total holdings, showing that Buffett views it as a key part of his investment strategy. By understanding Chevron's global presence and its significance in Warren Buffett's portfolio, we can see why it's considered a major player in both the energy industry and the world of investing. Let's explore American Express, AXP, and understand its role both as a leading financial services company and as a significant part of Warren Buffett's investment portfolio. What is American Express? When most people think of American Express, they immediately picture its iconic credit cards, which are used by millions around the world. But American Express is much more than just a credit card company. It offers a wide range of financial services, including travel-related services like booking and support for travel plans, banking products such as savings accounts and loans, merchant services, which help businesses process payments from customers, payment and expense management systems, which allow businesses to track and manage expenses more effectively. This diversity in services makes American Express a major player in the financial and travel industries, especially when it comes to serving both individual consumers and businesses. Warren Buffett's investment in American Express. Now let's look at how Warren Buffett got involved with American Express. Buffett's company, Berkshire Hathaway, started investing in American Express in 1991. Initially, he bought preferred stock, which comes with certain advantages like guaranteed dividend payments. In 1994, these preferred shares were converted into common stock, which represents regular ownership in the company. Since then, Buffett has continued to hold onto his investment in American Express, demonstrating his confidence in the company's long-term success. American Express in Berkshire Hathaway's portfolio. Today, American Express is one of the largest holdings in Berkshire Hathaway's portfolio. It makes up more than 8% of the total portfolio, showing that Buffett sees the company as a crucial part of his investment strategy. Key takeaways. 1. American Express, AXP, is famous for its credit cards, but it also provides travel services, banking products, merchant services, and expense management systems. 2. Warren Buffett started investing in American Express in 1991, initially buying preferred stock and converting it to common stock in 1994. 3. American Express now makes up more than 8% of Berkshire Hathaway's portfolio, showing Buffett's strong belief in the company's future growth and stability. By understanding the breadth of services American Express offers and how long Buffett has invested in the company, we can see why it's a key part of both the financial world and his investment portfolio. Let's learn about Moodys MCO, a major player in the financial services industry, and how it fits into Warren Buffett's investment strategy. What is Moodys? Moodys is a financial services company best known for publishing bond and credit ratings. These ratings provide investors and businesses with information about the financial stability of both companies and governments. Essentially, Moodys helps people understand how likely it is that a company or government will pay back its debts. Here's how Moodys works. It assigns credit ratings to public and private companies, as well as governments. These ratings help investors decide whether or not to lend money by buying bonds from these entities. A higher credit rating indicates that a company or government is financially stable and has a good outlook, meaning they are more likely to repay their debt. Moodys is part of a small group of agencies that dominate the credit rating industry. Together with S&P Global and Fitch Ratings, these three agencies control about 95% of the market for bond ratings. This gives them significant influence over global financial markets. Warren Buffett's investment in Moodys. Now let's talk about how Warren Buffett became involved with Moodys. Berkshire Hathaway received a stake in Moodys when it was spun out of Dun & Bradstreet, a company that Buffett used to own but later sold off. This means that when Moodys became an independent company, Buffett ended up with shares in it as part of the process. Since then, Buffett has held on to his stake in Moodys, making it one of Berkshire Hathaway's oldest holdings. Moodys in Berkshire Hathaway's portfolio. Today, Moodys represents about 2.2% of Berkshire Hathaway's portfolio. While it's not as large a holding as some other companies, it's still an important part of Buffett's investments, showing that he values the company's role in the financial services industry. Key takeaways. 1. Moodys MCO is a financial services company that publishes credit ratings for companies and governments, helping investors understand the financial health of these entities. MAR 2. Along with S&P Global and Fitch Ratings, Moodys controls 95% of the bond rating market, giving it significant influence over financial decisions worldwide. 3. Warren Buffett received his initial stake in Moodys when it was spun out of Dun & Bradstreet, a company he owned. 4. Moodys now accounts for 2.2% of Berkshire Hathaway's portfolio, making it one of Buffett's long-term investments. By understanding how Moody's helps evaluate financial stability and how long Buffett has been invested in the company, we get a clearer picture of why it remains an important part of his portfolio.